Good morning, this is Ken Long from Tortoise Capital with a daily debriefing for May 4th, 2016. Here's the report for tomorrow. Lots of overreaction and channeling signals to choose from among the indexes. The risk-C dipped into negative yesterday, so I'm very cautious about long side swing trades here. This is a market condition that is extremely well suited for volatile intraday directional trades because we've just tipped over into the beginning of fear. There's a ton of targets to choose from any of the swing trading system generators. Lots of good auto framers, many to choose from among ETFs or large caps. You can see that the volatility remains very low. That's why we're especially vulnerable to a volatility event. Weak trending market. Bulls are not in charge. The bears are in charge right now. That's consistent with this analysis. Oversold on a 10-day basis, still bull quiet. So this is such a mixed bag that tactical trading is really favored right now. Lots to choose from, like I said, from the Dow and the ETFs. And the auto framer target rich environment, and on the daily squeezes as well. Period polynomial regression is rolled over, although the 30 is still up. The slope is downward. We've pulled almost back to the 6-month average here in terms of the slope stat. You can see how the price is rolled over with respect to the 200, still in the positive, still bull quiet, but still vulnerable. Looking at the daily, you can see the slope of the 10 is down. The channel is tight but down. The pocket has formed in the elbow of the dragon here as it rolls back to, price rolls back to the Bollinger Band mean and is now testing the bottom of the river. Slope of the 30 is still up. Upside target remains 212, the swing high. We're about 3.5% off of that. We're still almost 12% off the swing bottom. This support is crucial. If this fails, then it's 202. And if that fails, it's the 200 and then 197, and negating all of this last 30 days of gains. Some from Yolanda. This was a long RLXD. My coaching on this one is that in a sideways quiet channel, let's get the breakout of the river before we enter. This one was a fractional loss. This one actually should be, this is a short, so I've said if we're going short at the opening, make that a red dot. So she's short RLXD, covers here, well done, plus 0.68. This one is also short. This is like a pocket reentry. Maybe it's a little slow, but that may have been a shock of a move and not been prepared for it. So I'd prefer to see the entry higher up in here. Still, I would take that one. And a reasonably good exit there. I like that. So total net about 0.3. Here's a... this was an error that was quickly corrected. He wanted to go... he was trying to enter a short. Covered immediately. Long on a hybrid, cashing at 2R. Long, cover. We talked about this one. The belief was that there was no condition number 2, an RLCO outside the river. I would say, look, this one is pretty close, and this is also very close to an RLCO. If this had been higher and dropped down, and this led us to the discussion of the failure of the belly of the dragon when you have things rolling over like this, and I'll show you later where we come to that. There's ways to get into this. Doesn't have to be an owl. That's not the only way we can get into those. But you got to watch the hump of the dragons and the belly of the dragons as ways to indicate a shifting in the regime, if you will. The trader was a little down on himself for saying, "How could I not take this trade when it's supposed to do when he's supposed to be short here?" And my general comment on that, from a coaching perspective, is this: is say, don't beat yourself up on this. Just treat it as evidence that we're looking that reinforces the idea that the failure at the belly of the dragon in a downward market, when that RLXD comes out, this is just a good place to get short. That's all it has to be. You need four things to make a trade: time, will, pattern, and money. If the will isn't there, it's not a thing to be judgmental about yourself. Like, don't spend the energy, or what's the advantage of spending the energy to beat yourself up why I didn't have the will? That doesn't restore will. That just makes it harder. Use that energy to be kind and forgiving to yourself, and recognize that the market is a infinite signal generator, and that it doesn't care if you didn't take it or not. It's always generating more. Spend the time to generate willpower. Just move on to the next thing. If the will was not there to trade, it just means that it wasn't there. That's all it means. Just move on to the next thing. There's not enough paper in the world to list all the reasons why we don't have the will. Let somebody else figure that out. That's not your job. Your job is to generate the positive energy needed so that you'll have the will more often when the other pieces are in place. So, it's just a dot on a map. Don't worry about it. Forgive yourself. Get ready for the next trade. It's hard enough to trade. So, just be gentle and forgiving with yourself. I want to spend some time on this sketch, and believe me, the power of sketching is enormous. So I want to talk about chain trading. So what we're looking for to get into the OWL or the P1 failure trade, right? Those are my two favorite patterns. Is it's got to be preceded by an unambiguous move. And I'm going to say, let's suppose it's an unambiguous down move. And that could have been caused by a hybrid frog or any other trade that represented a significant downward move. And this works on the upside too, but I'm going to use the downside. The unambiguous move is going to set up a number of conditions that look like the OWL if it does go up, or it will, if the OWL doesn't work, it will look like a P1 failure, and we'll take that. And then if these conditions don't lead to a clear-cut OWL or a P1 failure, what probably happens is you have a down move and it mucks around and it ends up becoming a sideways quiet channel. So really, after the unambiguous down move, we're looking for a reversion with the OWL or a P1 failure to the downside. And if one of those two doesn't materialize, then this unambiguous move apparently moved to the new fair price and it just became sideways quiet channel. So let's drill down a little bit further. So here was the close, here was the opening, and we have this little gap down here or whatever, or big gap down, doesn't matter. And then we have this unambiguous move down into a sideways chunk that looks like FTFF, failure to fail further. And this creates the conditions for number 2, which is the RLCO outside of the river. So the first thing we got to have in the OWL is number 1, unambiguous significant move. In this case, I showed it as, suppose this was a gap down, sold off, triggered a hybrid frog or a leapfrog, and something where we have some gains in that direction. That creates condition 1, the unambiguous move. Then failure to fail further is what allows mathematically the RLCO outside the river to occur. So the 10 crosses over the 30, and that's the conditions for a P1, RLCO outside the river. Now, condition number 3 for the OWL is that RL10 crosses the dragon. RL10 crosses the dragon. And now, as this RL10 crosses the dragon, you'll see that this price action is going to be enough to start causing the dragon shortly thereafter to turn and slope up. Dragon rising, number 4. And then also the RL30 will have started to flatten out, and as soon as it starts to hook up, we have the RL30 rising. So those are the 5 conditions that it takes to create that pocket, which allows us to enter at 0.6. So the pocket is formed in the elbow of the dragon, and now an entry can occur somewhere in this region that I've highlighted, with a stop down around Z-2, or the southern excursion of RL10. You can see examples in the chat room. Now, when the owl, what we've done is we've had the unambiguous move down, and now the owl has been created. If that owl pattern actually works and takes off, then what you'll notice is that RL30 will continue to rise, and in the successful owl trades, this RL30 looks like an excellent trailing stop, and you'll know it's a good owl trade because this thing never really gets threatened. The RL30 is kind of a guide. And then after this successful owl pattern, then all the follow-on pocket trades, they make for good continuation patterns of trades in that same direction until they fail. And when the continuation patterns here, the RLXDs, those little pocket continuations, fail, when that fails, that becomes an owl on the upside coming back down. So that's what the unambiguous down move going into the owl pattern looks like. But if we get in here and we get some or even all of these patterns, but they don't follow through with that nice smooth upward owlish type move, what you end up getting is a failure, and price, instead of moving up, rolls over at or near the pocket. And now what we want to watch for is this belly of the dragon. That becomes the gateway to a P1 failure. And that's where you have a pattern 1. It doesn't even get to the Bollinger Band mean, but rolls over and now takes out the belly of the dragon. And instead we have a price collapse and we have a P1F. So the owl pattern can lead to pocket trades going to the north, or if it fails, when you see the belly of the dragon violated, now we're looking at P1F failures. So in my view, in the second generation look at RLCO patterns, I believe we can wait for the owl or the failure of P1 instead of always taking the P1 with the target of the Bollinger Band mean. Remember, that's a counter trend trade. We had evidence of a significant move this way, so it's hard to believe that this is going to work. If we wait for the owl to occur, then there's enough wisdom that and evidence that this thing is taken off. Good. But if it fails, remember, the size of this move down when it breaks below the belly of the dragon, we estimate to be the size of this first leg down. So this would be downward leg 1. It tried to hesitate and tried to work, and then when that fails, boom, the size of this move is the size of this move. And so that's why the P1 failure is a favored pattern of mine. And on the upside, the owl is a favored pattern of mine. So that's a quick lesson for today. Here's one that was a very nice pocket entry to the downside, RLXD, got a little excursion. This is a really good exit to cash this thing and say, you know what, this thing had all this time to fail, but apparently there was enough interest right around in here to maintain it, and now the dragon and the 30 are starting to roll up. This is a good place to short that. It's a scratch trade. Well done. So this was a look back in the archives, and I want to expand on the idea of the collapsing dragon, that P1F kind of pattern that I just talked about. This was the text we were looking at. How can we get this trade into the script when this fails? So here's the template. Same pattern. Now, I want you to notice 1, 2, 3. Upper hump of the dragon, belly of the dragon, upper hump of the dragon. And when this rolls over, what you have is a lower high. And so now I draw my line from 2 across. That's the collapse of the dragon. And you can see the river slipping down. This is the not later than entry is the, in this case, the lower excursion of the RL10 where it rolled over is lower than the belly of the dragon. So the dragon belly entry was when that thing gets violated. The RL10 failure is here. So I just put 4 in the middle as my entry point. Not earlier than this, not later than this. Anywhere in here is a really nice entry, and you can see there's some pocket type qualities of this in here. So that's what I mean by the collapsing dragon. So here's one on XME. You have 1, 10 rolls over, dragon rolls over, lower hump, lower belly. It rolls over again. Now you have upper or a higher high, now a lower high, and now this is where the belly of the dragon failure entry is, and this line is where the RL10 entry is. And so you're short anywhere in this region, and if you covered around here, I'd have no objection to it. If you did cover, this is where you get short now in the next little belly of in the pocket where that thing, and now you have a 1, 2, 3, and now when that gets violated, you're short, cover, and off you go. Well done. That's an XME from today. Here's one that's a little more complicated in when you have a high, a low, a high. This is slightly lower, but even if that's equal, I don't mind. Now it rolls over, and now in this case, the belly of the dragon is equal to the RL10 Southern Excursion, so it's a single red line. That's where you get short. And in this case, the RL10 and the hump of the dragon are identical. That's why there's only one. In this previous example, I might say, look, use this one as a position sizing stop. If I'm short here, that's my position. And then this is my execution stop, so I'm only going to get a minus 0.4 if that one fails. In this case, they're both the same, so that's position sizing and execution. If that's too close, then use this as position sizing, yesterday's close. And now there's a secondary pattern. We have a 1, 2, 3, a high of the dragon hump, a belly, a high, and so we have a lower high at 3, and we got to get short somewhere, either not earlier than that red line, not later than that red line, so somewhere in here, got to get short and we got to cover. Somebody asked me, where are all these patterns? They're written up in between the glossary and on the website. The RLCO framework, the first generation, the 7 patterns of the RLCO framework plus the dragon. The second generation are more specific patterns that rely on these sometimes as descriptions or the larger theme, and then a refined entry, the owl, the pocket, the RLXT you've just heard me talk about. I consider this not earlier than, not later than. It's really that collapsing dragon. The P1 failure, the Z3 pinch breakout, and the Z3 pinch channel trades. These are various techniques we've developed for entry over time. The 1, 2, 3 entries and exits, morning hooks, WMB3s, failure to fail further, failure to follow through, using the high and low of the day for framing trades, and then ready, fire, aim technique. The elements of the frog framework, slow frog, quick frog, sleep frogs, and then my current favorite, the hybrid frog, the daily frog box, weekly frog box, and monthly frog box as components of that whole genre. We use different techniques like the regression line fractal framework, slope stats, alpha stats, and stretch stats to measure potential moves. The minimum manageable risk box is a way to frame your trades, ready, fire, aim, and some ambush techniques. For trade management, things like the no-lose plus dinner for 2, the Zeno stop and reverse technique, the 2R battle drill is essential. The use of the PSAR, parabolic stop and reverse, as a way to guide exits. The intraday measures of movement, gap stats, gain stats, fail stats, trade stats, failure to fail further, failure to follow through, and the idea of core and turbo or swing trading one day at a time. That looks like the menu of the intraday trade patterns. All of them are defined in the chat room, and that's my mindset as I'm looking at the daily techniques that are available. For me, every one of those is internalized because of study and practice. Here's one from Gil in Devon Energy. Owl, unambiguous move. RLCO, RL10 crosses. 30 is up, dragon is up, enter. Cash after an extreme move up and a 1-2. Beautiful. Find support, high or low. The dragon's still rising. Look, you got a low, a high, a low, and there's a pocket. Bang, long. Cash is well done. Finding your groove. This was really part of his VWAP magnet. He likes to look for excursions away from the VWAP, and and so if you draw that triangle, he's really looking for price to get up in here, and he's maybe able to get a couple very nice frame trades in there. Well done. Long hybrid frog, good cover. I wouldn't mind if you got short here. This is good capital preservation. Another look at the win series. So a high, a low, a high, and the dragon, and then 4 is the point where that dragon and the RL10 fail. You're short, you cover. If you try this as an owl, I don't have an objection. Long, it's not working. Short, this is the P1 failure. All right, this is the unambiguous move down. There's a failure to fail further. You cover that short. You try to get long here with the owl. It doesn't work. And the P1F fails. And when it fails below the lower belly of the dragon, bang, you're short. Bang, you cover. Well done. All right, that's one a little long today, but some things worth hearing. Ken Long from Tortoise Capital with a daily debriefing. Keep your risk measured and your powder dry.